Hello, everyone. It's Ken Winans and Stephanie Larson from Winans Investments, and we haven't had a video in a while. We thought it was overdue since we finished up earnings season and pretty much know where things are right now. So, before I get started, I just wanted to comment to everybody that we are going to have an in-person investment conference on Friday, June 23rd, and space is limited. So, if you think you're going to like to come, please contact Amy, and we're going to have Stephanie and I will be doing a presentation, of course, more in depth than what we cover in the videos. And then we're going to have other experts from real estate, lending, precious metals, accountants are going to be here to talk about changes in the tax laws. It's going to be it will be certainly worthwhile to come.
It'll also be on a webinar.
Yes, there will be a webinar.
Come.
Exactly. For those of you who can't come, if any of you are going to be coming in from out of town, we have taken the liberty of reserving some rooms at the local Marriott. So again, just let us know if you can try to come. But anyway, let's jump into the markets. Now, we were all a bit surprised to watch Silicon Valley Bank. I wasn't necessarily as surprised about, but First Republic I was. Yeah, this is a bank that was founded in 1985, became the 14th largest bank in the United States. Survived 2008, 2009, survived the 87 crash, survived the dot-com bubble, and managed to, unfortunately, not make adjustments for the rising interest rate environment, and it ended up getting them in trouble. So
I'm personally upset about it. I still know quite a few people that work there. I know they're really nervous. I think 3/4 of the employees have been let go. I just didn't feel that it needed to be seized. I found it ridiculous, to be honest, because the way that it was seized. I mean, Chase essentially got a sweetheart deal buying it. It didn't have to honor any of its debts, and I just think with it being backstopped, it just wasn't required. So, yeah. I mean, there's definitely a few new ones that are coming under a lot of pressure. Was it PacWest, I think, and one more?
First Horizon. These are regional banks. Now, First Horizon's been around since like the 60s, so it goes way back. But folks, what we're trying to tell you is this. I know there's a concern, this brings back horrible memories of 2008, 2009. The custodians that we work with are in great shape. They're different than banks. Banks are different than insurance companies. Brokerage houses are different than both of them. So just, it's just not something to worry about. Schwab is in a very strong, dominant position, and we're not concerned there.
We have had several clients reach out to us with concerns. So we just wanted to kind of assuage everyone's concerns and let them know that we're not worried about Schwab or TD or anything like that. So, but it is something that we are going to pay attention to. We do have pretty limited exposure to financials and banks in general, and we keep it that way on purpose. It's the same with energy. Those are the two spaces that you can really get bit on hard. Energy spot, can come through very weird cyclical seasons and have a lot of issues and have outside things control it, like OPEC, right? And it's nothing within our control or the natural supply and demand control. Financials are the other one. They're complicated. Obviously, I very much remember 2008. I've got a front row seat for that one. I mean, I remember when Lehman went down. So, I mean, we're always cautious with certain areas. Doesn't mean we're never exposed to it. We're just try to be limitedly exposed.
And actually, my next Forbes article that I'm going to be writing over the weekend actually is going to be covering how people who are not in financial services should be putting financials in their portfolio. Yeah. Let's talk about some other things that are in the news. So the dollar. A lot of you have been concerned about the fall in the dollar. The dollar was overpriced last year. I mean, when I look, and I'm taking it way back to when the dollar started floating back in the 1970s. The dollar was at a very high level, and it was actually concerns that it would affect, for the companies that do business internationally, it was going to begin to affect it. The pullback in the dollar is now putting it back into a range. It basically is back to where it was trading in about 2021, which is a normal range. It's still much higher than where the dollar was trading in 2008 and 2009. So again, I'm not worried about the dollar. Let's talk about inflation. Look, we're all thrilled to see the numbers are coming down, but I do want to give us a cautionary note. Inflation numbers change month to month. We're going into the summer driving season. I believe crude prices will begin to move higher again. It's one of the reasons that we're still maintaining fairly high exposure to energy stocks. I mean, that's going to happen. A lot of states are going to have to turn to raising gas taxes to help pay for upcoming deficits. So there's just a lot of things like that that could affect the cost of fuels. Food prices still are very high, but at the same time, there's other areas where inflation seems to be under control. The one area that I would caution everybody on, for anybody who does remember the 70s, once you have prices take off on products, companies feel compelled to have to raise wages, and that is happening right now. They're calling it wage inflation. A lot of companies talked about it in the first quarter. So again, we are not done yet with the inflationary battle. There's going to be a bit of a tug of war going back and forth between what the Federal Reserve is going to do and certainly what's going on in Washington with the debt ceiling. A lot of that's dealing with potential increases in borrowing cost to refinance the debt.
Touching on the debt ceiling, because that's the other thing we're getting a lot of calls about, people that are sincerely concerned about what's happening in government. You know, while that's outside of our control, we know as financial professionals, and so do everybody that is in Washington that's on that side. So we're talking about, you know, Janet Yellen and everybody. They know that a default is a non-starter. It just simply cannot happen. And while they do a lot of political haranguing with each other and they use it as a political football, it's kind of a joke because everybody knows they still have to raise it or rescind the debt ceiling altogether. So while it is a possibility that it could happen because they would be stupid enough to do it, everybody knows that would just destroy things right now. So the media, this is something that Ken and I talk about all the time. We're very frustrated with the media, but that's the media's job. The media's job is to scare you. It's to have you, if it bleeds, it leads. I mean, that's something that you've been saying for decades. I mean, it's just what they do. They need to have something on both sides to point to, or to have it be the next big thing that's going to happen and to scare the pants off everybody. But when it comes down to it, every single person, every financial person, every economist, every professor, they know they can't let that happen. So they're not going to. They might, be political, gamemanship around it, but they know they have to do it, period.
I think what would be more likely is that they would simply shut down Washington, shut down the government, lay people or furlough people. That's what they did before.
They did it 2 years ago.
And quite frankly, as I've told people when I do my radio interviews, I mean, if you want to worry about an area of the debt market, I'm actually personally much more concerned about the municipal bond space than I am the treasury space, but which, by the way, is better for the kind of bonds we buy. Because as I talk to people who have owned municipal bonds are now growing concerned about the solvency of a lot of the smaller issues, they're looking at corporations to say, well, at least with a corporation, I know who's making money, who's not making money, I can shift things around, and that's certainly why I think the demand in that space will continue to grow. Yeah. The stock market, many of you have been concerned about the market. I did not think that 2023 was going to go down as a great year for the stock market. Yes, I know some people are looking at the S&P 500 and say, well, golly gee, it's up on the year. But when I look at the Dow Industrial Average, the Russell 2000, the S&P 400 Midcap, our own Winans Legacy Stock Index, it's largely a goose egg. So what I would just say to everybody is that there's a lot of gyrations right now. There's stocks that we had a handful of them in our own portfolios that truly got punished in the first quarter because they missed their numbers. And I think that it's going to be that way for a while, but let me tell you what our end game is for this year. I believe that it's probably in August, September, although, Fed guessing is always a bit of a crapshoot, not necessarily an art form. Yeah. At some point, the Federal Reserve is going to say, we're neutral. Yeah. It doesn't mean rates are going down. It just means they're done tightening the money supply. They're done raising interest rates. When that happens, certain segments of the stock market, I think, will take off because now they're going to say, great, we now know what we're dealing with. We're done. I think bonds will take off. One of the areas that were very heavily punished in the first quarter because of the banking crisis were preferred stocks. They will take off as well. So what I'm trying to tell everybody is that we're just going to have to, not so much sell in May and go away. It's more, don't be afraid to hold cash through the summer But when they're done, you have to go after it, and not all the news is going to be good. You have to be prepared to jump in and go, and that's certainly what you pay us to make those decisions on. So that's pretty much the way we see it right now. Stephanie, you want to add anything? Or?
Yeah, I think the only thing I'd touch on a little bit more was the preferred space. I mean, they're getting beat up for two reasons. One was the financial crisis. Second was because preferred stocks act like long bonds. So as rates go up, longer termed bonds, their prices go down more, right? Well, preferred stocks tend to mimic that. So the thing is, we've bought a lot in the last 2 months, I think. Been really aggressive of putting them in clients' accounts, trying to adding to them and getting them for cheaper, so that when they do recover, we'll see that really nice appreciation. In the meantime, they're still paying their dividends, so they're good to have. But it's been unfairly punished. So when our client looks at a normal bond portfolio and they're thinking, well, bonds are generally safe and their price volatility isn't that high and they're pretty consistent. Well, it's for the last year and a half, it's not been like that. The price volatility has been very high. Doesn't mean we've had a lot of defaults. We only have a couple problem children that we watch, and we watch them every day. So, but yeah, the preferreds have gotten hit too. So you'll see that in your portfolios, but we do think it's temporary.
And also, do keep this in mind, especially people who have income investments in their portfolio. When we give you a report, it is meant to show you this is where you are year to date. It does not tell you how much interest or dividends you're going to get for the remainder of the year. It does not tell you what your paper is worth, especially the bonds, when they come due. So especially the first half of the year, I think reports and performance reports for anything that's an income portfolio, they're fine, but you realize you haven't gotten everything yet. So
Sure.
I just again realize that there's still a lot of moving pieces out there. But look, at the end of the day, we're here every day. We're working hard. We're trying to reposition things. We're making adjustments in all of our portfolios right now. Cash levels will probably continue to be relatively high, at least until we have a better sense of where we're going with things. And we'll just take it from there. But one final point, these kind of markets, they're not for the faint of heart. In some ways, last year was easier than this year. And what I mean by that is, when the market was blown up, we have a standard battle plan. Put on hedges, raise cash, cut back, hold back until things can. When you have a sideways moving market, and we have not had one of these in quite some time. In fact, the year that so much reminds me of this year was 1994, when Alan Greenspan suddenly was raising interest rates and no one knew why. Market did the same thing. It was just a goose egg, but very volatile. So the thing is you want to be cautious about is over trading. When you try to overtrade and jump into what's ever hot last week, you can find yourself just all tied up and bound up and not really being logical about it. Stephanie and I are putting our list together of what we want and when we want to buy it and what prices we will buy it for. But we're willing to be very patient and just bite our tongues and wait through this thing.
And actually, a lot of our positions are doing really well.
Oh,
I
yeah,
mean,
absolutely.
some are at all-time highs or so far off of their 50-day moving average, we couldn't buy it for a new account if we wanted to. So we're actually in a pretty good position. We're looking to make up as much ground as possible by the end of the year.
Absolutely, yeah. And then we're talking about the ground from last year.
Yeah.
So, folks, it's always good to give us our videos. Sorry we've been so late. We've been just kind of downright busy with things here. We hope to see you at our conference. We'd love to see everybody here. And, obviously, have a good Friday at the conference. And then on Saturday, Sunday, go drink some good California red wines not too far from our office. But anyway, everybody, if we don't see you between now and the summertime, do start off your summer well. And we'll talk again soon.
Sounds good.
Bye-bye now.
Bye, guys.